learn about RBI, its structure and function, and accordingly various monetary policies. Now, every country has a central bank. For example, in USA, this central bank is called Federal Reserve Bank. In UK, this bank is called Bank of England. And in China, if you come, this bank is called People's Bank. But when you come to India, this is called RBI. Now, RBI was formed on the recommendation of Hilton Young Commission under the Reserve Bank of India Act 1934. So its headquarters was first Kolkata, and later on in 1937 was shifted to Mumbai. Now let's look at the structure of RBI. RBI has one governor. The current governor is Raghu Rajan, who is the 23rd governor. Below the governor, there are 4 deputy governors and 20 central board of directors. Now, all these board of directors have to meet 6 times a year, or at least once a quarter, to form the policies. Also, there are 22 regional offices and 4 local boards, local RBI boards, which are in 4 metro cities: Delhi, Mumbai, Kolkata and Chennai. So this is basically the structure of RBI. Now, when RBI was formed, let's look at the objectives of RBI. RBI basically wants to provide short-term or long-term financial stability and financial growth to the country. When we talk about financial stability, basically we are talking about price stability. We are talking about food procurement procedures, and we talk about financial growth. We want to talk about long-term investments, and credit expansion, which means how much money to go to which sector, which should be balanced. So this is the basic objective of RBI. Now RBI has certain tools to achieve this objective. So RBI whatever function it does through certain tools. Now these tools for RBI is, one is, first and the most important is open market operations. In open market operations, basically RBI sells bonds or securities to control the various financial aspect. We will talk about it in later. Then also RBI control the interest rates and the bank rates. Again, we will talk a lot in detail about interest rate and bank rates. Also, RBI has a huge control. It is the sole authority on controlling the SLR and CRR. Both of these we will talk in detail. There is also something called credit rationing through selective credit control, which means that suppose RBI wants to give boost to the infrastructure sector. So what it will do is reduce the interest rate for infrastructure sectors. So RBI can decide which sector will get how much loan credit based on some rationing system. Also, RBI forms the moral suasion, which means it brings out certain moral guidelines for various banks and other moral codes to help banks decide how to conduct business. And finally, there is some exchange control, especially foreign exchange control mechanisms, which help us RBI do whatever its objectives are. Now we have seen the tools, and so let's have a small look at what are the functions of RBI. Now if we see, as already said, functions of RBI, the main functions would be that it is the sole authority which controls the supply of money or credit in the economy. So basically RBI decides how much money will be available in the market, how much money to print. Okay. So it is the sole authority to do that. Second big function is it is a banker to the government, of India. So government of India, it is the first banker. It will take loans, it will sell credits, whatever it is. So it is the main banker to government of India. Also, it is banker to commercial banks. So all the commercial banks, SBI, ICICI, all those, it is a banker. RBI is the banker of banks. So what happens? It will supervise all the banks. Suppose a bank is running out of money, RBI will provide them money. So all that, it is a banker to all the banks. Then also it is the final authority when it comes to foreign exchange. So foreign exchange related matter is all under RBI. Okay. Also important, it prints currency notes, right? And it prints all the notes except rupees 1 note, which is printed by foreign secretary, finance secretary. Also, RBI has an important here. It disseminates all financial data. So financial data in terms of how much is the deposit of all the banks, how much is the credit of all the banks, everything. This function is carried out by RBI. Now, next what we will learn is certain these basic terms which we have learned: SLR, RR, CRR, bank rate, interest rate. We are all going to take all of these one by one and explain you what these terms mean. The first term today we are going to discuss is SLR. Now SLR, the full form is statutory liquidity ratio. Now the word statutory, you know, is by law. This is the meaning of statutory. So by law, okay. So what happens, I'll explain you in detail. You know, every bank has demand liabilities, which means it has certain amount at any point of time to pay to its to pay to the people who have deposited money in there. So this demand deposit further can be of two deposit: time deposit, means fixed deposits, those kind of deposit, and demand deposits. So suppose on a particular given day, so like say 1st of April, a bank has to pay 10 crores for time deposit and 20 crores for demand deposit. So total demand liabilities for bank on that particular date is 30 crores. So this says, a statutory liquidity ratio says that of all the demand liabilities, the bank will maintain a certain percentage in liquid assets. Now what does this liquid asset essentially means? You know, is in form of cash, in form of gold, in form of bonds or securities. Now there is another important concept very related to this, which is the CRR, or cash reserve ratio. Again, what it says is that at any point of time, the bank of all its demand liabilities should have cash, in form of cash, a certain percentage in form of just cash. Now, and that also cash deposit with RBI. Now I'll give you an example to demonstrate both of this. Let's say, for example, a bank, as we have said, has a total liability of 100 rupees on one particular day, right? Out of this 100 rupees the bank has, let's say the bank, you know, deposits 10 rupees in RBI as a deposit, okay, in form of cash. Now also it buys 10 rupees of gold from RBI, or deposits, you know, 10 rupees of gold and 5 rupees of bond, right? So 25 rupees is exhausted. Now the remaining 75 rupees the bank use for operations, for all the functions whatever it consists of. Now by law, no, if you leave the bank, if you don't form any regulation, the bank will not deposit anything, because neither this cash nor this gold nor this bond provides a lot of earning opportunity for the bank. Bank will like to spend maximum amount in its, you know, operations, lending money to people to earn interest. But what happens is, if it uses all the money here and here, and if some people ask for the money, they will not have the money. So what RBI does is, it forms a cash reserve ratio, that at certain point of time the bank has to put certain amount of money in cash with RBI. So whatever money in cash the bank puts with RBI, this forms the cash reserve ratio. In this case, the cash reserve ratio is 5/100 or 5%, which means that minimum, so RBI says that okay, the CRR will be 5%. So minimum 5% of the entire money has to be kept with RBI in form of cash. This is important. Suppose this is important because suppose the bank and the RBI increases the CRR, cash reserve ratio, to 8% or 10%. Now suddenly the bank has to put more money in form of cash with the RBI. So it will have less money for operations. So money from the market will be reduced, right? So similarly SLR. So SLR is all these things: cash, gold and bond. So this is SLR. So in this case 25/100, 25% is the SLR. Suppose the bank the RBI increases the SLR by 5% or say make it 30%. So bank again has to put put money from here and put it in these forms to match their SLR requirement or CRR requirement. So if we want to summarize this, we can say that SLR or CRR is inversely proportional to the money supply. So suppose SLR or CRR increases, the money supply in the market will decrease. Okay, so if the bank wants to increase the money supply, what it will do, it will decrease the SLR or CRR. So this is one of the most often asked question, so I have taken a little time to explain. Now let's move to bank rate. Now bank rate. Now let me give you first model to explain everything. What happens, we have Government of India, we have RBI, and we have commercial banks. Now what happens, this RBI actually prints money. Okay, so this money is required by Government of India. So what RBI does is, it gives Government of India the money, right? And what Government of India does, it gives RBI certain bonds, government bonds, also called as securities. So basically it is a bond paper which says that RBI has given me 100 crores and we will pay RBI at 2% or 3% or whatever this is. Okay. Now again RBI, what it will do is, it will give money to commercial banks also, and it will charge interest, right? Also RBI can sell these bonds also to the commercial banks, right? Commercial banks, and at a certain rate. So suppose the government is paying RBI 3% interest, the RBI can announce a rate of 4% to the commercial bank. So suppose, because commercial bank, if they put some money back into RBI in form of cash reserve ratio or SLR, they are not going to earn any interest on that. But if they buy these bonds, what will happen is they will get some interest. So there are two very important words here which I like to highlight. One is purchase, second is repurchase. Okay. Repurchase is when RBI, the commercial banks repurchases the government bond from RBI. So whatever this rate, it is called as repo rate. So repo rate is the rate at which commercial banks buy securities, government bond from RBI. So this is the repurchase rate. So commercial bank is buying bonds or securities from RBI at a certain rate, that is called repurchase rate, right? So there is another thing which is called as reverse repo, which means now at there certain time when the bank will like to sell back this bond to the RBI. So this is called reverse repo rate, which means that the rate at which RBI buybacks the government securities from the commercial banks, this is called reverse repo rate. So suppose now how it how they use it basically, let me tell you. Suppose the RBI wants to decrease, so RBI wants to decrease the money supply, right? So it wants to take away the extra money from the market. What it will do is, it will increase the repo rate. So bank, if they buy the government bonds, they will have more interest coming from the government bonds. So what will the bank do? Since they are getting more interest, they will buy more government bonds, and since they are buying more government bonds, the money with the bank will decrease. You got it? So what happens is, once the RBI increases the money supply, what happens? Bank, they feel that they earn more from the interest, and so they buy more government bonds. And what happens? The money, since they buy more, so more money goes to RBI, and once more money goes to the money supply in the market decreases. The reverse happens when the RBI increases the reverse repo rate. So these are the two important rates by which RBI manipulates how much money is in the market. let's look at another. So I hope all of you have understood this. So basically government of India sells RBI some bonds and security. This is purchased by the RBI, and the RBI further sells it to the commercial banks like SBI and all, right? This is called repurchase, and the rate by which the commercial bank buys these bonds and security from the RBI is called repo rate, right? So if repo rate increases, the commercial will buy more bonds and securities, and the money supply in the market will decrease. Okay, the reverse happens in reverse repo rate. Reverse repo rate is when the bank is selling the government bond back to the RBI. Okay, now hope you have clear. Also, the government of India has to pay back the money to RBI and buy its bond. Now, how will the government of India get the money? In form of income tax, in form of other taxes and earnings. Okay. So let's move to the next important topic, which is licensing of bank. Again, for a licensing of bank, there's a lot of it can happen under section 22 of Bank Regulation Act 1949, and there are certain criteria required. One is, like, say, minimum there should be a 500 crore capital. Then also there has to be the locations of the bank available, okay, the number of branches, all these information has to be there. Then also the interest of the people has to be looked after. The national interest, so bank should not act against the interest of the bank. So another thing is that annual profit of the bank, out of that 20% has to go to the reserves. So if I form a bank and out of 100 crores I have made 20 crores of profit, so out of this 20 crores, 20% means 4 crore has to go to this reserve every year, right? And even if you have got a license to open a bank, for every branch you have to take license, right? Permission, not license, permission to open every branch. And why the government keeps this particular is so that they can control. It should not be that all the banks are opening all the new branches in only cities, not in bank. So they will have. So this is all the concepts related to licensing of bank. One important thing is bank holiday is different from public holiday. So there is a different list of holidays by bank. Both is declared by government of India, but it is different. So these are the two important concepts relating to basic licensing of banks. Now the third concept which we'll talk is capital account convertibility. I have already taught you this in the last video, but just to summarize, it is with what is the domestic financial assets can be converted into foreign financial assets. So suppose domestic financial asset is, suppose you have bonds, securities, rupee notes. How easily they can be converted into foreign financial assets? So if there is a full convertibility, what is the advantage? Because any investor can easily come and invest. So the big advantage is that there is more availability of fund, because anyone can come and invest easily. So there is more availability of fund, but there is a big disadvantage because also they can take their money back soon. So there is a lot of volatility, means the price fluctuation or the fluctuations in the market is very, very high. suppose a person, 5 people, they invest $10 billion in one day, so the market will rise very fastly, and the next day they exit, they remove their money, the market will crash very fastly, and they will make the money, they will make the profit because they bought at a lower price, and once they have bought it, the price have gone high. Once the Indian people start buying it, since the price is, they will buy at a higher price, and the foreign people will they will exit the market, so they will profit, the foreign people will profit, and Indian people will be at a loss. So this is the major disadvantage of capital account convertibility. The next thing which we are going to talk about is SEBI. So for all this we have got Securities and Exchange Board of India. So SEBI is an organization which is Securities and Exchange Board of India, and what essentially it does, it protects, it controls any kind of investments, domestic as well as foreign, in India, and also it protects the investors. So its main function is to make sure that there is no market manipulation and the interest of the investors are safeguarded, right? So if we look at the structure of SEBI, there is one chairman and there is 3 full-time members, and there below them they have executive directors. So this is the structure of SEBI. So basically SEBI, they will ask the full form or what is the function. So it controls the investment and protects the investors. Next important concept which we are going to learn is participatory notes. So participatory notes, now as you know that we are going to talk about participatory notes. Now as you know that they are foreign investors, okay, ready to invest in any economy, right? Now to invest in Indian economy, they need to be registered with SEBI and follow all their norms, so which is a very tough thing. So not all foreign investors want to kind of get registered with SEBI. So there is a middleman. Middleman means there will be an agency or an organization which will be registered with SEBI, and they will take the money from the foreign investor, invest in India, and they will provide participatory notes to this particular foreign investor. So basically what happens is the foreign investor invests into India through some middleman, and this middleman provides participatory notes that's saying that okay, the foreign investor has invested in India and bought these many shares of this company. So this middleman ensures that all the SEBI regulations are followed, and the foreign investor gets the profit and they can invest in India. So this is a legal way for foreign investors to participate in India. That is why it is called participatory notes in Indian economy, okay, without getting into the hassles of registering with SEBI and following various norms of SEBI. Now next agency we are going to talk about, again a very important agency, is IRDA. Okay. Now which is full form is Insurance Regulatory and Development Authority. Now this is the full form, again very evident from its name. IRDA is it protects and regulates the insurance sector in India. IRDA protects and regulates the insurance sector. Okay, it was formed under Malhotra on the recommendation of Malhotra Committee under IRDA Act 1999, and its headquarter is in Hyderabad. Right now, one important question which is coming is, what is insurance repository facility? Now it is nothing but e-policies, which means whatever policy you buy. Earlier what happens that if you buy a policy you get a policy paper. Now you can buy online all these policy papers is online in a central repository facility which is called e-policy. So obviously all your policies, even if you buy from any one bank, two bank or any other bank, it is in a central facility. So this is something which these IRDA have brought e-facilities. Another one important thing which we are going to talk is ULIP, which is Unit Linked Plan. Right? ULIP, the first time ULIP was started by Union Trust of India in 1971, and basically what it does is it combines insurance and investment together. So suppose if you are putting money in bank and you are earning an 8% interest, or if you are putting money in stock market and you are earning whatever the capital gain is, that is a kind of investment. And suppose you are paying LIC a life premium, so that is a kind of insurance. ULIP is a unique plan in which both insurance and investment is linked. So this is what ULIP is. Now let's go to the next. We have talked about open market operations by SEBI. RBI. Now open market operations is nothing, as I told you, but buying and selling of bonds by RBI. So suppose RBI sells government bonds, okay, what will happen? Commercial bank will buy, RBI sells government bond, okay, at a good rate interest. What will happen? Commercial banks will buy, and then what happens? So money from the market decreases. Okay. Similarly, RBI buys the government bond, then it will, if it buys, then the commercial bank will sell and money will increase. So this is what open market operations is. So there will be a lot of questions on open market operations. Another important concept is hot money. Hot money, again, what happens is, suppose you are a big investor, you have got 100 crores, right? So what happens, you can easily invest in one place or another, whichever provides you higher interest. So it is a short term but volatile flow of money from lower interest instruments to higher interest instruments. So suppose you have 100 crores and today bank is offering you 8% interest. You invest all that 100 crores in bank. Next day what happens, that another bank is offering you 8.1%. You take all these 100 crores from bank A and invest it in bank B, so that you get that 0.1% extra. So there's a lot of flow in the market, and which kind of leads to volatility in the market. Now the third important concept would be mutual fund. Mutual fund, what happens, there is a pool of investors. So it's not one investor. So pool of investor investing in a pool of stock or bonds. So this is what mutual fund is. There's many people who pull out, who bring in their money, okay, and there is a company in between who will do this, and they will buy a variety of stock. So what it does, obviously it reduces the risk for individual people and it increases the rate of return, which means that the rate of interest will be decreased. Now this mutual fund is a kind of this what you call is a mutual fund. Basically it's a trust, kind of trust, okay, which is formed, and they buy. Yeah. There are certain terms related to mutual fund which you should know, right? One is NAV, which is called as net asset value. Since it is a pool of stock, so whatever the average of pool of stock is, that is called net asset value. Suppose the average today is 100 rupees and you have invested 1000 rupees. Today NAV is 100 rupees. You have invested 100 rupees, so you will get 10 units of this particular mutual fund. Suppose NAV becomes 90, so your amount will become 9000, you will 900. Suppose the NAV becomes 110, your amount will become 1100. So net asset value is how you determine the functionality of a what you call mutual fund. Also there are terms, very important terms, such as lock-in period. Lock-in period is the amount of period. Suppose if you buy a mutual fund, how much minimum time you have to stay invested in that particular mutual fund. Normally it would be 3 to 5 years. It depends with the mutual fund. Also there is tax benefit. Suppose there are certain mutual funds which if you invest in that, the return which you get is tax free. So there are tax benefit. To another word is entry load and exit load. Entry load is suppose you are buying a mutual fund of 1000 rupees and there is an entry load of 1%. So 1% of the 1000 rupees, that is 10 rupees, is the entry load, which means that you will have to, it will be cut as a processing fee. Exit load is suppose you sell that particular policy and exit load is 1% or 2%. So out of all the final value, 2% will be cut because you are exiting the year. Then there is AMC, annual maintenance charges, with mutual fund. Now let's move to the next topic. There is something called sovereign mutual fund. Now it is nothing but the state owned, suppose government of India, state owned, which means that suppose government of India, government of China, government of Nepal, mutual fund. So government, if they start a mutual for themselves, for their employee or for general people, okay, in which they will again invest in a stock or bond or real estate or even precious stones, metals, okay. So any kind of mutual fund which is started by the government, state owned, that is called sovereign mutual fund, right? So this was all about the mutual fund. Now very shortly we will do certain banking and commercial laws. Okay. Now banking and commercial laws, basically it is all regulated by Banking Regulation Act 1949. Now it applies to all the banks, which is commercial banks, which applies to cooperative society. Cooperative society is again all the people, suppose they form a group of people, form a society which acts as a bank, that is called cooperative society. But it is not applicable, this is the question which is generally asked, it is not applicable to agricultural credit societies. So Banking Regulation Act 1949 is not applicable here, but it is applicable to cooperative societies as well as commercial bank. Now, there is a lot of laws, and you need not know everything, but I will just enumerate all the important things. This is just to learn. Like say, minimum 20% of profit of each bank, I have already told, will go to the reserve every year. So why it is? Because so that bank can have a lot of reserve money, so it will never go out of operations. There is also a section 31 which says that bank has to go for audit every year. Now there is another law which says that 51% of the bank board of directors should have a special experience in terms of banking, in terms of economics knowledge, in terms of agriculture, so that whosoever is in the board of director, they know the banking sector properly. Okay. Then also there is a very important law which is called Negotiable Instruments Act 1881, which generally talks about, they have sections from 138 to 142 which talks about check dishonoring or fraudulent. So the question will be asked, which of the sections is with dishonoring or fraudulent? So section 138 to 142. So there is also a whole lot of sections which I will just mention, like say section 4 is on promissory notes. I will explain a little about these things in detail just now. Section 5 is on bill of exchange. Section 6 is on checks. Section 8 is on holder. Section 9 is on holder for value. Section 10 is on holder in due course. Section 123 is on crossing and definition. So all these things we are going to discuss. Now, first important thing which I'd like to talk is the difference between transferable instrument and negotiable instrument. So this is generally will be asked in exam. So what is a transferable instrument and what is a negotiable instrument? Suppose instrument is nothing but a what you call mode. So suppose there is a banking instrument, I'll tell you in detail, and it is stolen. So if it is a transferable instrument, even if it is stolen, the value will belong to the original person. But suppose if it is stolen and it is a negotiable instrument, the value will be become to the person who stores it. Now suppose there are two kind of banking instrument I am going to take as example. Suppose currency notes and bank check. Suppose a person steals currency notes. So currency note, suppose I steal currency note, I can keep it. Now it belongs to me. It does not belong to the person who initially had that currency. So currency note is an example of negotiable instrument. Suppose comes to bank check. Even if I steal somebody's bank check and it does not have my name on it, I will have to return it, because still the owner is the person whose name is on that bank check. So bank check is an example of transferable instrument. I hope you got the point. So currency note is an example of negotiable instrument. Bank check is an example of transferable instrument. Okay. So certain more transferable instrument, I'll just write. It is checks, promissory notes, and bill of exchange. Now all these are relatively similar. I'll tell you a difference. Now promissory note is, it says that unconditionally, suppose if I write a promissory notes for you of 20 lakhs, which means that when you present that that particular promissory note to bank, the bank will have to pay you 20 lakhs, even if you are a thief. Okay, even if you are a smuggler, which means that there is unconditionally, and even if I want, I cannot stop this particular promissory note because I have given it to you. Bill of exchange is, it's a kind of promissory note, but I put certain conditions on it. So suppose I give you a bill of exchange of 20 lakhs and say that this has to be given only when you are able to deliver me 10,000 shoes. So that becomes a bill of exchange. Bill of exchange is when it's a kind of guarantee that yes, you will get 20 lakhs, but only when you produce 10,000 shoes to me. So you are sure that once you present that 10,000 shoes legally, you can get that 20 lakh rupees. If I am not able to give, I will be at fault. So bill of exchange is that. Check is, as you know, you write a check, you can stop it. So check is something between promissory and exchange note. Someone has a check, they can go and get it, but at the same time you can also stop the payment of a check. So these are the time. Also there is a lot of question on types of check. So just have a look on the type of check issued. One is a bearer check. Bearer check is once you write that okay, pay Amit Kumar 2,000 rupees. So it is a bearer check. It has your name. One is an open check. Open check is nothing but a blank check. So there is no name on it. Suppose you go into a bank and you want to withdraw money from your own account. So what you give is an open check in your own name. Okay. So open check, if anybody goes and gives the bank open check, the bank will give that same person the amount of money. Third is an order check. Order check is when you write, pay on order, which means that the check will be on somebody's name, or on his name he can take it, or he can order the bank to pay in somebody's account. So suppose if I have given you check and I have written Amit or order, so that particular check Amit can get deposited in his account, or he can order it to be deposited in some third person's account also. It is Amit's decision where he wants to get it. Third is cross-checked. Cross-checked is nothing when you put two parallel lines like this on the on a check. So this is cross-check. In cross-check, what happens? You put some specific instruction, like say account pay, which means that this check has to be deposited in anybody's account only. Nobody can take a cash. So if I give you an account pay check and cross like this, even if it is your account, you are the bearer of the check, you cannot take cash. You will have to get it deposited in some account, right? So there are various other instruction you can put it in cross check. So these are the now another three words I will tell you is, one is holder, okay, one is holder in due course, and one is holder for value. Now all these three are generally they will use basically holder is someone who holds it. Now suppose I have given you a check of 2,000 rupees, so you are holder of that particular 2,000 rupees. Suppose I have given you a post dated check of holder of 2,000 rupees, so that 2,000 rupees is not till the date is particular has come, so you are holder in due course. Now third is holder for value is, suppose I have given you a check of 2,000 rupees, okay, subject to the condition that certain person gives me 2,000 rupees. So you become the holder of value. These are like suppose I'll give you an example. Suppose I have a person, there is a bank A, there is a bank B, okay, and I am a person Abhishek. So I have deposited 2000 rupees in bank check of bank B in this. So what happens? I become a holder for value till the time this is this bank gives the money to A. So I'll get the money only when B gives to A. If I have deposited a check of 2000, in B's name. So these are small. These are very technical things. Just need to know, so that if some question comes, you can solve it based on it. Now there are certain important sections which you should know. That there is a section 15 in this particular which deals about coercion, which means that unlawful use of force or threatening to gain consent. Suppose I put a bullet in your head, and a gun on your head, and say that please sign the check. So this is illegal. So unlawful threatening to get consent, right? Then there is also a term called conversion. Conversion is, suppose something does not belong to you, but you use it unlawfully. So unlawful, the legal word would be unlawful interference with another person's property. So this is conversion. So again, two terms it was mentioned, I don't know. Now a very important thing I will talk about is CTS 2010, which is full form is check truncated system. Now earlier what used to happen is every bank used to have a different check. So they would have different logo, different paper, different marking. So suppose I deposit a Bank of Baroda check in a State Bank of India. Earlier what State Bank used to do is send the check to Bank of Baroda physically, get it verified. Once it is verified, Bank of Baroda will put the money in SBI account and then it will pay to me. So this was a lot of time consuming. It was not very safe because the check used to be transferred from one place to another. Okay. So what RBI did was formed a uniform check for every every banking organization. So they will have similar kind of paper, similar kind of marking, only the logo will change. So and now what happens is the check is not transferred physically. Any bank, suppose now if I deposit this particular bank check, Bank of Baroda check in SBI, they can easily check if this check is original or not, because all the checks have similar paper and everything. Once they check that, what they will do is just scan the check and send the digital copy to the required bank, and the required bank can actually confirm that yes, this check is valid based on the check number and the account holder's name and everything, and then it can digitally send the money. So that physically movement of check has stopped after CTS, which is check truncated system. So now this is the standard, and every bank now follows this check truncated system. Suppose the Bank of Baroda feels that this is not an original check, it can now ask for a physical check to be sent. But for 99% of the cases, they will do the transaction on just the image basis. Now just few data that once a check is deposited, the bank has to clear it within 10 days. Okay. Otherwise it will have to pay a fixed deposit ka penal interest. Okay. 14 days is for northeast region. Suppose Sikkim, Manipal, Sikkim and all those northeast regions, this limit is 14 days. If more than 90 days has happened and check is not still cleared, then the bank will pay fixed deposit plus 2% penal interest. Okay, so fixed deposit rate is 8%. If the bank is not cleared that particular check within 10 days, then the bank will be paying you interest. Now I'm just about to end for today particular year. Now one important again concept is bouncing of check. suppose a check you have issued but it is bounced. So after 1989, this has become a criminal liability. Earlier it was a civic liability. So you can get jail if your check is bounced. This is very important. Now, then what can we learn? There are certain acts which is mentioned. I will just mention the name. Partnership Act 1932. It deals about all the laws and clause about partnership. Basically, there are two kinds of partnership. One is registered and the second is non-registered. Right. Then also there is a Indian Companies Act. (1932). Okay. Now various type of company is public limited, private limited, then obviously company limited by guarantee. As you know, public limited is the company which has taken public money. Private limited is when, so it will have minimum 7 directors. Okay, private limited is minimum 2 and maximum 15 people who can invest into a private limited company. And company limited by guarantee is basically non-charitable, non-profit companies. Now there are few terms which are mentioned. I think you should know it. One is ultra wire. Ultra wire is nothing. Suppose if Dynobel, who is a software company, goes and buys real estate, so it is not doing business which it says in its memorandum of association. So the fault it says is ultra wide, that it is not following whatever it has said. Now there are two doctrines. One is in Companies Act, doctrine of indoor management, which means that any company, only internal people can make all the decisions, external people should not be involved. So this is doctrine of indoor management. And one is doctrine of constructive notice, which means that anyone inside the company has to know, okay, any director or has to know what is the memorandum of association for the company and act accordingly. So suppose tomorrow if Dynobel and we start buying real estate and the government says that you are doing wrong, we cannot say that, oh, I didn't know it. I have to know that what this company was supposed to do. Okay. Then there are two another laws. One is the Transfer of Property Act 1882. Again, just an act. And one is Banker Book Evidence Act 1891. So this is important, last one, that suppose there is a criminal or civil case, the bank can provide your statements as a evidence to the court. Suppose there is a court case that I have not paid you the money, so I can take bank statement and say that yes, I have paid the money on this date on this particular and bank has to provide me that particular evidence. So this is Bank Book Evidence Act. Also there is something called minor age. Minor age in India is 18 years, which means that till 18 years you are a minor. After 18 years you are a major, so you can make all your financial decisions. But in certain cases, when the court has appointed a guardian for you, right, then you are not a major till 21 years. So then the minor age is 21 years. Below 21 years you are still a minor. So this was all. Let me know, it was a very big